Hello, everybody. Welcome to the first quarterly webinar of 2023. My name is Josh Stirling. I'm the Director of Portfolio Management here at Klaas Financial. And today I'm joined with Eric Schwartz, one of our advisors, and Kite, our CFO and advisor as well. Today, we're going to plan on going over a lot of content. It's going to last about 20 to 25 minutes. At the end, we're going to have a little Q&A session. You should plan on that being about 5 to 10 minutes. So if you have any questions throughout the majority of the content, feel free to look down towards the bottom of your screen. You'll see a little Q&A button. Go ahead and click on that, submit any questions that you might have. We'll do a roundtable at the end and answer anything that comes in. Today, we're planning on talking about a couple of big topics that have happened recently. So, of course, I'm sure a lot of you have heard the banking crisis that happened recently here in February and March. And then we'll move on to a core topic that we've talked about quite a bit already, which is around inflation and rising interest rates to help combat rising inflation rates. And then we'll round everything off with a topic on portfolio, what's been happening in the markets recently, and how that's impacting you. So, as we move into the content for today, I do want to briefly talk about what Klaas Financial does for anybody who might be new to these webinars. So Klaas Financial has been around now for 47 years. And we help individuals and families plan for retirement and plan for investment management along the way. We have 2 offices in 2 different states, Madison, Wisconsin, and Loves Park, Illinois. We help over 1,000 people across all the states nationwide. So, Kyle, as we get into the content today, can you lead us off with a discussion on what's been happening in the banking industry?
Yeah, thanks, Josh. Obviously, this was one of the biggest headlines probably through the first quarter. Feels like it's been a little while ago now, though. It's fast. It's crazy how fast the news cycles change and all that kind of stuff. This was like a really big thing for a couple of weeks, and now it's kind of disappeared into the background. Part of that was because it was fairly isolated. I mean, there was really the 3 big names that people had heard about. The first one was Silicon Valley Bank. They were probably the biggest. But then you also had Signature. And then one of the oldest institutions, Credit Suisse over in Switzerland and things like that. So what I'll focus on today is the Silicon Valley Bank and what happened and why they went under. And I think once I kind of explain this, you'll realize why it wasn't as big of an epidemic throughout the full banking industry. Things like that. So Silicon Valley Bank, you hear this word perfect storm quite a bit, but it truly was. In today's day and age, for a bank to go on a run like that, they kind of had a perfect storm that happened to them all at once. So let's start with kind of their depositor base. They are very focused in the Silicon Valley space, obviously. So founders, things like that. Typically people with a lot of money, and a lot of it is more than FDIC insurance. So that was kind of what started some of this stuff. So when you have a very narrow depositor base, that obviously brings in some risk, especially when you think of most of these people are in tech and different things like that. Well, tech last year in 2022 had a really rough year as far as stock prices and things like that go. So a lot of these people were needing money out to meet payroll, all that kind of stuff too. This was, like I said, kind of isolated because basically what happened is they had, just a couple of their larger depositors kind of got a little shook, and then they all kind of talked to each other, and then they all decided they wanted their money out of the bank at the same time. So that's what caused the bank run. So because of that, Silicon Valley Bank was forced to sell some positions, extremely safe positions. I mean, they were government bonds essentially, but they were at a huge loss because, as we all remember, bonds had a really rough year last year due to interest rates rising, which I'll talk about here in a second. But essentially, they were forced to sell government bonds at a huge loss because all of these people were trying to get their money back out of it. So that was, again, just something that you're not going to see with like a JP Morgan Chase, who is massive, has depositor base all over the place, that type of stuff. And it was really poor risk management. Obviously, we've specialized a lot in money management and things like that. The types of securities they were buying, again, were super, super secure. It's not like they were bad securities. It was just matching up the investments for the environment that we're in with rising interest rates and things like that. They were just forced to eat some big losses that they probably shouldn't have been suspect to in the first place. So obviously this is where the FDIC stepped in to provide liquidity and stabilize the industry. So most people are familiar with FDIC insurance is good for 250,000, and there's different ways that you can get more than that with ownership of accounts and things like that. But really they were kind of forced to step in, and they essentially backstopped basically all of the deposits inside Silicon Valley Bank. So that was an interesting piece. Some people think that, oh, they got bailed out. Well, no, the shareholders of Silicon Valley Bank still took a massive loss because the bank went under. But it was more the FDIC just making sure that the depositors that were there got their money back out of the bank as far as that goes. So,
I mean, it was kind of a interesting situation. It wasn't like something where the bank didn't take on any risk. I mean, they took on some pretty substantial risk, and they had kind of known about this risk well before the Fed started raising interest rates.
Mm-hmm.
I mean, when your depositor base is full of tech startups, like you said earlier, I mean, it's just about the cash burn. They need to operate. And when revenue kind of goes down, and they also operate at a loss typically as a startup, I mean, you're going to go through cash. And so all this kind of led into that entire spectrum.
Yeah, and it's interesting too, because this isn't like a taxpayer bailout or anything like that. The FDIC is a insurance corporation that all the banks pay into. So Jamie Dimon, some of you may know, is the CEO of JP Morgan Chase, one of the largest ones. He mentioned something in his investor letter a couple of weeks back that they've paid in $12 billion over the last 12 years just into FDIC insurance. So this is what this program is designed to do. And it's honestly something that the banks have to pay into for this insurance coverage. So you can probably take a guess that probably they're going to have to pay a little bit more into it going forward because it's going to be beefed back up, right? So,
yeah. And I mean, FDIC insurance isn't something that's unused at all either. Since 2001, we've had over 560 banks closed by FDIC, where they had to step in and actually bail out the bank and pay back the depositors, and then kind of take over the assets of the bank and liquidate those as you have time. So it's interesting that we hear all these news stories and all this kind of a little bit of panic, but the FDIC stepped in, did their job, and even went above and beyond in this case.
Yeah, and it's been said here over the last couple of minutes, but it really felt like, Kyle, you're saying like the perfect storm, right? This was a primarily serving an industry that was really fast growing, that had money pouring in prior to rates rising, the tech space. And we were talking about it. Silicon Valley Bank has been one of the largest or fastest growing banks. So they were just used to money pouring in the door.
Mm-hmm.
And the idea of putting some of their deposits in longer term treasuries that weren't going to be at par for a while probably didn't scare them much, because they figured the money would just keep coming in till rates rise, right?
Yeah.
And here we are.
Now, we should say, if anybody wants to really dive deep into this, of course, we want to keep things a little bit lighter here. But if anybody wants to talk about management of duration and how far in advance like management team knew about this, what they were kind of doing behind the scenes, feel free to call in, because these are things that we've been talking about internally, and banks are more confusing than you think that they should be on how to get run. So we're always available to talk the talk, but we want to keep it a little high level today.
All right, so let's talk about the interest rate hikes that we've all experienced over the last 14-ish months right now. So obviously, when we look back at the beginning of 22, interest rates were essentially zero. And then obviously the Fed has been kind of steadfast in their mission to get inflation under control. One of their biggest tools in the toolbox to do that is to raise interest rates, which is going to restrict the money supply. So it makes capital more expensive, essentially. But what we've just gone through is actually the fastest rate hikes in history. They raised them higher and faster than they did even back in the 80s. So I'll draw your attention here to the little right side little box here. So like I said, the beginning of 22 it was essentially zero, and by the end of just last month here, March of 23, it was up to 4.65. So that's a 450 basis point roughly hike in just over 12 months, which, like I said, we say this a lot, is actually unprecedented. I feel like that's a very used term for things that we go through these days. So again, something that we've never really seen, but it looks like they're at least slowing things down and they certainly have over the last couple months here. That's honestly what some of the stock market's looking at too. So they did 25 basis points back in March, then they did the 50 in May of 22, and then they did 4 consecutive 75 basis point hikes, so 0.75%. And they did another 50 in December. And then in the last couple months here, February and March, they've done 25 basis points. I would say the thinking still out there is that they may still do a 25 basis point hike here at their next meeting. But that has certainly kind of, if you would have asked the market 3 months ago, it was almost a no-brainer that they were going to do 25 basis points. But now there's actually some skepticism if they're going to be able to pull that off with as fast as the economic data is changing and kind of the data that they're getting in.
Well, Kyle, I'll kind of lead you into this discussion because I definitely have a couple of thoughts on it as well. But I mean, I've heard some things about the market, what they're pricing in for the end of the year. What are your thoughts on kind of like what's going to happen with interest rate future?
Yeah, this is part of what's so interesting about the stock market, right? Is what the Fed is looking at is backwards looking economic data, where of course the stock market is trying to price in the future, right? Which none of us can predict the future. So, you know, up until the last probably 4 or 5 months here, the market kind of thought that they would kind of hold rates steady. But now there's actually some talk and there's some bets on Wall Street that they might actually start cutting rates by the end of the year, if you can believe that. It's again, the market is kind of super afraid that they were going to go too far and raise interest rates too high. And that was going to throw us into a deeper recession, which we'll still see how that plays out. But because it seems that inflation is under control, which we'll talk about this here in a little bit, that's leading the market to think that cuts may actually be on the table by the end of the year, which is interesting. We would not have said that even 6 months ago.
So if you're following the market, and you're following the news, what's kind of happening, I'm sure you've seen a couple of those headlines come out. But a little bit more behind the scenes, we've heard from fixed income managers like Guggenheim, PIMCO, that suggests that these rate cuts, even though they might be kind of priced in, might not be looking at it in the most logical way as well. A rate cut may be possible, but they also suggest that no rate cuts might be happening as well. And it might actually be the more probable solution. And a lot of that has to do with the Fed's positioning on waiting things out to see how the market reacts. Because when you raise interest rates, you're not going to get an immediate kickback. Like all these companies just laid everybody off, or prices have started plummeting again. It's a very delayed reaction. And you kind of see that in the graph here, how they take their time with these interest rate rises, even though it's been an unprecedented, just multiple interest rate raises up to 75 or 0.75% there. It's been very fast, it's been timely, and they take time to pay attention to what's happening. And if they stop raising rates, it may or may not happen this year that they start cutting rates, but it could also get pushed off to the following year.
Guess we'll see who's right.
Here at Klaas, we give no opinion. But we always entertain it. It's interesting to see what's going to happen and play out. So, Eric, how have these unprecedented interest rate increases impacted everybody?
Yeah, I feel like for the last year at least, we've been talking about this on these webinars, rising rates. So we want to talk a little bit about how those are actually manifesting in everyday life. One of them that we've talked a few times about as well is what rising rates have done to the housing market, right? So we're seeing 15 and 30-year mortgages at rates triple what they were 3 years ago. Right now, if we look, and we've talked about this as well, if we look relative to history, how high rates are, I'm sure a lot of people listening or watching right now are probably saying, well, I've had mortgage rates at much higher rates than they are today. But relative to where we were just a few years ago, like I said, we've tripled the rates. Credit cards are charging higher interest rates than they were just a year ago or even a few years ago. Even better reason not to carry a balance on there. But that's impacting consumers as well. And we're seeing, I think largely in the business community, we're seeing companies having to reduce workforce, lay people off. We're hearing reports of companies pausing or foregoing capital expenditures. Basically, like Kyle was saying earlier, it's more expensive to access capital. So businesses are making those decisions to hold off for now. And I mean, really, this is all by design, right? This is what the Fed expects when they raise rates. When we have inflation the way it's been, the goal is to slow down the economy. And so far, I mean, what we're seeing play out is kind of exactly what you think they would expect.
Yeah, and you could argue that the kind of the two sectors that needed to slow down the most were housing and car loans, right? So anybody that's tried to buy a car in the last couple of years, prices were really high, and housing was going up 20% year over year, which is not sustainable, right? So those are kind of two of the biggest industries that needed to get contracted, and rising interest rates will obviously do that, which is kind of what they were going for. To Eric's point, it's been an interesting, unprecedented hike, and they may have missed the ball on inflation back, 14, 15 months ago, but they had to try and keep up and make up for lost ground here. So it's probably the right thing to do. But again, it's just the market's so worried that they're going to go too far and tip us into a deeper recession than we need to be in. So we'll see how it all plays out.
Yeah, I think it's also pretty interesting with the workforce, the layoffs that we're seeing. They seem to be pretty concentrated, and when they happen, it seems like they're relatively small compared to what we've seen back in like a 2008 or different recessionary environments. So hopefully it's continues this way, but we'll have to wait and see what happens in the job market. But it's a very strong labor force currently still.
And the job market that you brought up, I mean, it remains really strong, and which again, it's so interesting because we talk about all of these things that are maybe good signs, or they seem like good signs for inflation, but they're actually not good signs for just the economy in general, or in some cases people's lives. But we're kind of looking at inflation being the number one enemy here in the recent months.
Let's go ahead and look at inflation.
Yes, we can't stop talking about it. We just got our March numbers a week or so ago now. And for the 9th straight month, CPI is down again. Came in about 5%, which beat expectations. Day later, we got the producer price index, which is basically like wholesale pricing, and that came in even lower than expected as well. So we got two quote unquote good or slowing inflation reports. We are still above the Fed's ultimate goal of about 2%. Seems like a perfect world at this point in time. But I mean, it's hard to argue that with the idea that the Fed's strategy seems to be working right now. Working means slowing down the economy and making some parts of life more difficult, but that's really the decision and the challenge of the Fed chair, right? Is to decide whether or not we're going to continue to kind of hold the economy back. But from an inflation standpoint, it seems like it's working.
I think this next slide that we're going to look at is going to have a slightly more complicated graph. Yeah, but
It is complicated, but we've been talking about inflation for the better part of a year now, and so we want to just stop and just take a closer look at what makes up the CPI, the Consumer Price Index. This is largely what people are talking about, at least consumers in the US, when they're talking about inflation. And so you can see March 2023 and March 2022, we have the CPI, the top line. There's that 5% number. So compared to a year ago, inflation is right now at 5%. In March 2022, it was at 8.5% year over year. So I wanted to kind of dig into what the good news was in this most recent report, and what's still kind of lagging behind and staying expensive. So we saw gas and fuel prices continue to slow. We saw used vehicles come down in price. Kyle mentioned those earlier. We saw a very modest reduction in food cost. I think we can all agree, going to the grocery store, it doesn't feel like it, but we had about a 3.3% reduction month over month, led largely by eggs coming down for another month. That's another one I think is hitting everybody.
that's a big one on my shopping list.
Yeah, we had a 7% drop the month before, and then 10% in this most recent one. But I think on the flip side, in relative terms, things like food and shelter remain really, really elevated in terms of inflation. And these are the ones that really people feel the most. You know, I mean, gas and fuel is another one, and that seems to be easing a bit. But you know, we're still at 5% inflation, right? We're still higher than what we're used to in recent years.
I think what a lot of people really talk about is what's in the headlines. You hear about the gas and oil, you hear about the vehicles, food costs and whatnot. But looking at this graph here on the left, services makes up a huge proportion of CPI or general inflation that we typically look at. And that's what's also included in the core CPI, which strips out some of those more volatile measurements. But looking at the biggest subcomponent of everything, right on the outside of that circle is shelter. It makes up over 1/3 of inflation. And it kind of makes sense when you look at your own personal finances. And if you're paying off a mortgage, you're paying rent. It makes up a really big size of what you pay for in your everyday life. But it's something that has really kind of stabilized in America. It really hasn't fallen off a cliff like in 2008, 2009. And so it doesn't seem like it's poised to fall off a cliff. There's still pent up demand for housing. People that have homes or have mortgages don't want to sell their home and have to get a 5, 6, 7% interest rate on a 15 or 30-year mortgage. So it's going to be difficult seeing a way for inflation to kind of come down with housing prices keeping it up there because it makes up such a big component. So as we start to see some of the other components have more sizable decreases, that can also help lead to a reduction in inflation.
Yeah, I would say that's probably the most, I wouldn't say most surprising, but it's certainly a big topic in that people thought that with interest rates going up as high as they did, that the housing market would just fall through the floor. And that's, like Josh said, that's actually not proven to be that true. There's not as many new mortgages. The numbers just came out the other day, and that dropped significantly for mortgages. And, you know, some people are actually, they can't afford to move because they locked in such a low interest rate on their mortgage. And why would you give that up and pay double just to upgrade your house and things like that? So the housing market continues to be an interesting kind of thing going on here. And like Josh said, it's such a huge part of the overall inflation that it might be tough to get down to 2% in a reasonable, in a really quick time frame or anything like that. So
now, one thing we should always say is that real estate is very location dependent.
yeah,
So
100%, yeah.
over on the West Coast, it's a slightly different story. So we have seen housing prices go down. But on the East Coast and in certain locations in the Midwest, we've seen them stabilize or even raise quite a bit.
It's a supply thing at this point. So
Yep. Buyers are motivated, sellers are waiting it out.
Yep.
All right. Well, I'm excited because I get to talk about some of the more fun topic this time. Feels like it's been a little while since we talked about positive returns. So what we're looking at right here is a really short time period. Up on the screen right now is just looking at this past quarter. But when I look at kind of positive performance, it's actually been going back to the fourth quarter of 2022. Our last webinar that we did, we focused on kind of the annual return, but fourth quarter of 2022 was actually a pretty good quarter. Over these last 2 quarters combined, what we typically reference our global 60-40 portfolio, 60% equities, 40% bonds, returned 12% during that 6-month time frame. So it's been a very, very good environment. Even though we're not back to all-time highs, we're still above pre-COVID levels where we were at all-time highs way back in 2020. But it's kind of been turning into that slow and steady return. But the first 6 months of this has been pretty fast. It's been pretty aggressive, which is great to see. But looking at this slide right here, we wanted to kind of break down what's in the subcomponents of a 60-40. And again, this is a pretty simplistic view, but looking at it from some big categories, we're going to focus on kind of geographical locations and just the equity versus fixed income side of things. There are many other ways that you can break down what you're invested in, but this is kind of what we're going to focus on today. So looking at the equity markets over the past 3 months, it's earned a solid 7.4%. Like I said, it's a pretty substantial amount that I don't think anybody was necessarily expecting to happen so quickly, especially with the banking crisis. But we haven't seen that equally throughout the different sectors. So tech industry has just flied last quarter. It was up 22% last quarter. But then on the finance side, when you kind of include the banks in the situation, that was down about 6%. And both of those kind of helped to impact what our global equities actually saw by the end of the quarter. But when we dig a little bit further under the hood of the equities, we can look at US equities. Big winner was international developed equities, but both of them were up by quite a bit. International developed equities was primarily led by European countries. So you have your Ireland, Italy, Spain, Germany, all returning over more than 10% last quarter. And a lot of that had to do with a milder winter. And that was something that was expected, that was going to be a big trouble as there was conflict happening with Russia, Ukraine. There was going to be a tie down on how much natural gas was going to be delivered to certain countries, especially Germany. Germany had a lot of its natural gas shut off, and there was a big risk that Germany was going to just get walloped during that time period. But because of the milder winter and the Germans' reaction to kind of like building out more infrastructure, more energy programs, they actually were able to kind of make pace with some of their goals. One of their goals is being 100% renewable energy by 2045. And it seems like they're somewhat on track for that. So a lot of those expectations around international developed countries really kind of have been reestablished, and it resulted in really good equity returns in those international markets. So it's something that we haven't seen for a while, but it's something that we hope to see kind of stay and add those more diversification efforts to the portfolios. So the next bit is looking at that little orange box down below. And I know 3% on this page isn't really exciting, but I'm going to be honest, I'm very excited about that 3%. We are in just a new era of fixed income. And so we're going to move on to the next slide here to kind of dig into what's been driving the return in fixed income. So as I move to this next slide here, this is a slide that might look a little familiar to some people who joined last quarter. Last quarter, we wanted to talk about the falling bond market because that's what we all experienced back in 2022. Bond portfolios that had just been resilient for a long time were designed to add diversification into the portfolio, kind of be the bellwether while the stock market was going all over the place. Didn't really play out that way in 2022. A lot of this had to do with the rising interest rate environment. But one of the key things we wanted to focus on during that conversation was that rising interest rates also have a subsequent kind of factor to them that maybe it doesn't hit you right away with what's going to end up happening. And that is your payments on your bonds are going to increase over time. And so that's what we're looking at right here. So we're looking at right here an annual interest rate payment on a $100,000 bond portfolio over the last 1 year and 3 months. And even as bond portfolio prices have gone down, the amount of money dollar for dollar you're receiving out of that portfolio is slowly started to sneak up. And so the last time we met, it was $2,700, $2,800 annually that you receive in interest coupons. And that was quite a bit more than what we had back at the beginning of 2022. And still, as we're moving along ahead here, you're seeing that those interest rate payments are continuing to increase. And so this new era of bonds is just starting to pay off. And we're starting to see bond portfolios recover a little bit. Not all of the 3% return that we had at the start of this year was due to interest rate payments, had to do with a little bit of fluctuation. But it's something that we can look at and say, this might be a new reality that we're looking at, where interest rate payments are increasing. You can actually generate income off of bond portfolios. And that's a big win for a lot of our retirees. And being able to generate that income off of a lower risk portfolio can be really helpful for those who need that stability over a long period of time. All right, so the last part that we wanted to talk about is kind of the benefits of diversification. And so some of you might be familiar with what this chart is. But for those who haven't seen this chart before, it is called a Callan chart. And we want to pause here and kind of explain this because there's a lot on the screen right now. So a Callan chart, the goal of this is to show that diversification provides consistency and some level of stability. And it's also meant to show that some of those sub assets that we talked about, like fixed income, US equities, international, emerging markets, tend to be a little bit more volatile. But in a 60-40 bond portfolio, you add all these items together to try and create diversification. When one zigs, the other one zags. And so let's first look over on the left-hand side. This is only going back 5 years. This is much shorter than we typically look. Typically, when we look at historical values, we're looking at 20 plus years, but we just wanted to simplify this down. So in 2018, see at the top, fixed income. And as we go down, we notice that the returns go down as well. So that 2018, you had fixed income stabilizing. 2018 was when US and China tariff war started beginning. And that's also when Jerome Powell was starting to make comments about, we might raise interest rates. So you had kind of a market freak out right in December, right at the end of the year. I'm not sure if anybody remembers that, but it was kind of a very interesting time that nobody was really expecting. But as you move on from 2018, 2019, 2020, you see those boxes starting to move around. But the one thing that's consistent is that the top returner is always at the top. So you have fixed income, US equities for a couple of years, fixed income again, and then so far year to date this year, we've had international developed markets do incredibly well. So, but the one last thing I'll have you focus on is right in the middle there, the global 60-40 bond portfolio. That is really designed to be the stable piece with diversification that you can invest in for a long period of time. And also kind of leads into why we don't necessarily focus on trying to overweight certain parts of the market or try and pick and guess or really try to do research and come up with an educated guess as to what's going to be the best thing the next year. Because slow, steady diversification means that you're going to get those benefits over a longer period of time. But it also means that you don't have to rely on somebody being right and that you can have that consistency, that lower volatility that you might have if you were just all in on like emerging markets over the last 5 years. That might not be too good.
Yeah.
So this is just a small example here of a simple Callan chart. These typically get a lot more complex, but we didn't want to show something that's a little bit overdone.
Yeah, and I think you hit the nail on the head and you said we're looking at a 5-year time period here, right? So when if we look at a longer period of time, you're going to continue to see just a lot more differences in terms of who are the winners and who are the losers over that time. But this just goes back to what we tend to talk a lot about here is diversification and creating a situation where we can avoid the extremes, right? Especially for a lot of our retirees who are taking income off of their portfolios. We want to try and create as much consistency as possible.
Yeah, and I think Josh said it well. We hear this all the time that, last year's losers are this year's winners, right? Well, look at the last 6 months that Josh mentioned. Tech in 2022 was the worst. And so far this year, it's actually been the best, right? Mm-hmm. And to take that even a step further, if you were to go back, why we say that you don't time the market, like Josh said, over the last 2 quarters, so fourth quarter and first quarter, it's returned about 12%. But you have to remember that October was about the lowest this market got to, and that was part of the fourth quarter. So if you would have panicked and sold out in October, you would have missed this run up. And guess what? It's only been 5 months. Now, we don't know if this holds, if it gets better, worse, whatever it is, but that's just putting in a synopsis of this is why you can't jump in and jump out all the time, and why our advice a lot of the time is just stay the course and make sure that you're in the right strategy for you long term, because month to month, week to week, this stuff goes all over the place. So
yeah, that's the really important part, making sure we have you in the right level of risk for your needs and for your risk tolerance, right? Mm-hmm. So we can, we've talked to people a lot about this over the last 1.5 years, 2 years now. This idea of you may be in a position to take more risk, and maybe you're not as dependent on your investment portfolio for income. as other people might be, but that doesn't change the fact that some people just don't really have the stomach for extra risk, right? Even if we tell them, well, it's okay, you're not taking the money out this year. For some people, it can just be a situation where they say, long term, I'm not comfortable in a portfolio this risky. And that's part of our job to help you figure out, how much risk do you need to take to create the amount of income that you need in retirement? And where is that sweet spot of your ability to take risk and your desire to take risk?
Yeah, we all want to make as much money as we can and not lose anything, right? That's our goal for everybody, right? Unfortunately, to make decent returns, you have to take a little bit of risk. So when we talk to clients, it's always, what can you sleep with at night, right? Because if you're losing sleep at night, wondering about what your portfolio is doing, you're probably too aggressive, right? And it really comes to fruition when you go through a year like last year. You find out who your true investors are versus the people that have just enjoyed the ride up over the last, basically 13 years here since 2008. So when you go through a year like that, it really tests your mettle of staying invested and, knowing things are going to work out okay. So,
yeah, we hope our clients aren't just watching the tickers go across the screen every single day. That's what we do. That's what we're here for. Here to help out there. But yeah, it's important to be relaxed with what's kind of happening with your portfolio, knowing that your plan is going to go as it should. All right. Well, we're going to go ahead and move on to the Q&A session here. But if anybody has any questions they'd like to submit, we got a few come in, but we'll have a little bit of time here. So if anybody has any more questions, feel free to go ahead and send those in. So let's start off with the I-bonds discussion. We actually had a few questions come in on that, talking about two different things. Are I-bonds still a good place to keep extra cash? And then if somebody owned I-bonds over the past year or so, with the repricing of the interest rates, are those values going down?
It's a good question, Josh. Yeah, it's I-bonds were kind of all the rage over last year and probably a little bit in the fourth quarter of 21, even because I-bonds, remember, are linked to inflation. So when inflation's running high, the I-bonds were paying nice interest rates. Now we're on the other side of that thing though, and inflation is coming back down, which means the rates on the I-bonds are going down. So as of right now, they're still paying pretty decent interest, but again, the market's looking ahead and there's talk that the I-bonds might go below 4%, down to like 3.9, whereas basically a year ago, they were paying 9.62. So it significantly does change the interest that they pay. However, I-bonds don't go down in value, right? So the most people bought in were $10,000. You were just clipping your interest coupons. That's going to continue. Your $10,000 is still there. Just those interest coupons that you're getting are going to continue to go down if inflation continues to go down. So, but the important thing with I-bonds, remember, is that you have to hold them at least a year. So for people that just bought them in the last quarter or so, you might be actually kind of forced to hold on to them for a little bit longer and just get your lower interest rates. But again, we kind of joke about that even 12 months ago to get 3.9%, which is what they're talking about going down to, was still really good interest. It's just now that interest rates have risen, it doesn't sound quite as good because you can find a CD that's paying 4% and 5% now and different things like that. So
right. And also keep in mind, after you hit that initial 12-month required holding period, any time you take money out before hitting the 5-year mark, you're essentially paying a 3-month interest penalty. Now, it's not that it's a reason not to do it, just something to be aware of. So let's say you've held an I-bond for 18 months and you decide to redeem it, you're essentially going to get 15 months of interest rather than the 18 that you actually held it there.
Mm-hmm. All right. So we actually have two different questions on this, kind of some different perspectives to look on it. So what happens if we go into a recession, and can we define an economic recession, and are we currently in that?
That's a very loaded question. So the definition of an economic recession is 2 consecutive quarters of negative GDP growth. So that's the technical definition of it. As far as if we're in one, it's again a good question because you don't get the official definition of a recession until you're already well into it, right? Because again, 2 consecutive quarters is at least 6 months of negative GDP growth, like I said. So it's hard to say if we're in one. And like I said, most of the time you don't know that you're in one until afterwards. But again, like I said earlier, the stock market is actually forward looking. And I would argue that if we do enter a recession here in 2023, which again, that's a pretty, it's a pretty likely scenario as far as the market's concerned that we do enter a recession if we're not already in one. But again, the market knows that this has been probably one of the most telegraphed recessionary looking periods that we've seen in a long time. So the market, again, looking forward, is already priced in some of the bad economic data. And that's why it was so interesting, especially in the fourth quarter of last year, is that good economic data, meaning the job rate staying high and all that kind of stuff, was actually bad for the stock market, because it's just given more ammo to keep raising rates, which again, the worry in that was that was going to cause a worse recession than we need to go into. So
it's frustrating when this is bad news.
And then we finally got a jobs report that was showing, it cooling off a little bit, and then the market said, "Uh-oh, are we going into a recession?" So it's the Goldilocks situation.
But I think, Kyle, you said it right. It's important to separate the two: the economic recession, which has been predicted widely, maybe not super widely, but to be minor. And I think as we kind of get those confirmations as to what's currently happening, as we've gone 3-6 months down the road, and we kind of get those confirmations coming in, we'll start to see the market kind of get a little positive drive out of that. Like, oh, we're right. Okay, we're coming out of it.
Right.
The real turning point is if we get pushed into a deep recession, which, I mean, when we look at the economy currently, Kyle said it well about the jobs market is still pretty solid.
Yeah.
It's one of the lowest unemployment rates that we've had in a long time. I think dating back to maybe the 60s, 70s. I may be incorrect on that, but
yeah.
And then on top of that, you have just a solid housing market as well. You're not seeing housing prices starting to collapse.
Yeah. And you can have certain sectors of the economy are going to feel like they're in a recession already, right? Like if you work on in tech and you got laid off, well, guess what? You feel like you're in a recession.
Yeah.
Right. Now, we haven't really seen a lot of blue collar layoffs and that kind of stuff yet on Main Street, as they like to say. So that may be why it doesn't feel like a recession. And it could be that it's not going to be a 2008 type recession where everything gets blown up either. It could just be certain sectors get slowed way down, and that does officially tip us into a recession, but there's going to be certain sectors that go along just fine too. So
all right, so we'll move on to one of the last questions here. So again, if anybody has any additional questions, I think we just have a few more minutes here, but I think this is a really good question, and I think we can spend a few minutes on this. So with rates being pushed off, or kind of being pushed up, hopefully starting to trim down a little bit here, seems like there's more risk to the downside versus the upside. So even when rates come down historically, could there be another drop in the market? What could we be looking towards? And so I think I'll ask both of you some of this, but I think the perspective we need to look at this is in two very different perspectives, especially when we're talking about the market, the fixed income market, the bond world, and then the equity side of things, because they could both act very differently with continued interest rate increases. So do one of you want to talk on kind of the equity side of things, or I can talk about the fixed income as well?
Yeah, it's a good question. Again, it's hard to, you can't really predict how the market's going to react to these things. All we can do is go back over history, right? And so typically just because, interest rates start falling, that's not necessarily a bad thing for stocks. It just depends on, certain sectors, cost of capital, those types of things have bigger impact on equities. And, some of our biggest companies sit on a ton of cash, right? Your Apples, your Amazons, they have a ton of cash that they're sitting on. So they're not even necessarily beholden to interest rates as much as some of your smaller businesses and things like that. So it's just really hard to say how falling rates are going to impact equities. Fixed income, which I'll let you talk about, Josh, it's a little more easy to decipher what happened.
I would throw one other thing here, just one part of the question being, it seems like there's more risk to the downside right now than there is the upside. This isn't exactly related, but I think I would have said the same thing in March of 2020, right? It would have felt like there was a lot more risk to the downside than there was to the upside, yet, 4 months later, we're back at all-time highs in the stock market. So while I see that, I understand the concern, especially given what we've come off of in 2022, I think history has taught us that it's just timing the market perfectly and maybe sitting on the sidelines for an extended period of time is just really difficult, close to impossible to do.
Yeah, and this, when you, again, history, the stock market does not go down 2 consecutive years very often. It certainly happens. It could happen, absolutely. But if you go back statistically, it doesn't happen all that often. So that's, again, when you start looking at history, it doesn't predict the future, but it puts things into context of what we're living through and things like that. Sure.
I mean, on the equity side of things, there's always going to be downside risk. And we're getting fed a lot of negative information right now about, oh, this could happen if like different opinions happen. But there's always a very big chance that the market goes up. And there seems to have happened over the last 6 months, but you talk to anybody and it's just, there's a lot of negative news over the last 6 months, a lot of bad things that are happening, but it's been a big drive in the market over the last 6 months. And we've looked at graphs like this before that talks about if you miss out on the market returns right after big negative drops, you can miss out on a lot of important returns that really drives the overall return in the market. And so that's kind of why we talk about not really trying to time the market and just trying to stay consistent, focus on your goals, focus on your controllables. Because when you look at all the downsides that could happen, you're going to feel a little bit more negative towards what potentially could play out. But the stock market, it's a beast. It keeps going, it keeps running. And over the last 6 months, we've seen a really positive environment.
Well, you can look over the last 100 years, right? Like we've been through multiple world wars, we've been through various economic recessions, that type of stuff. It's averaged about 7% a year. Now it's got cut in half multiple times over those 100 years. You got to ride with it. But again, history would tell you that as long as you stay in it long enough, you're going to have positive returns. It's just nobody knows exactly when those best days are going to be. And historically, the best days are right around the worst days. So.
All right, so this is a really great question. We're going to continue it here. We are coming up on time, so I'm going to try and cover the fixed income, the bond side of things relatively quickly. And I'm going to do something that we typically don't do, and we look down on here. I'm going to use a term in the fixed income world that's a little bit more confusing. So the bond market is actually kind of a little bit backwards to the way that the question was phrased. Is there more risk to the downside than upside? And so one of the big pieces is that it impacts bond pricing is interest rate fluctuations. And so if the Fed were to come out tomorrow and say, we're going to raise interest rates by another 1%, the fact that interest rates are already so high means that they're not going to be as impacted if we made the shift from 0% to 1%. Back when we made that shift at the beginning of 2022, that was painful. That was really painful. And then interest rate expectations kind of went through the door and things got a little out of control. And we ended the year 13% down in the bond market. But now that interest rates are much higher, our average bond portfolio is earning 5% yield right now. There's a term called convexity, which talks about as interest rates increase or decrease, how much does it really impact that portfolio? And the higher your interest rate is, interest rate changes thereafter have smaller impacts, especially when they go up, because it's less of a proportionate increase that's happening in a simplified term. Now, if interest rates start to drop, though, well, that's going to be a big benefit, a big boon to the bond portfolios. And we think we might see that, but we don't know for sure. Interest rates may continue to increase, especially after this next interest rate rise, if it happens. But the important thing is that if interest rates remain stable for a long period of time, that's big for a lot of our clients, a lot of retirees, because it means, like we talked about many times during this conversation, that you're going to start getting more income off that bond portfolio.
Yep. And like you said earlier, these aren't historically high interest rates, right? Most of our clients on this call remember the 90s when, guess what, mortgages were in that 6-7% range. And we had a great decade for the stock market throughout the 90s. So it's not like it was back then. It's like Josh said, it's the shock of going from 0 to 4.5, 5 is a lot different than going from 6 to 7, right? Mm-hmm. So it's just something that there's no easy answer.
All right, so we apologize. We lied. We said that we were going to be on for maybe about 25 minutes for our presentation, then maybe 10 minutes for our Q&A. We're at 15 minutes right now. So we're going to go ahead and we're going to end the webinar there. We really appreciate everybody joining in with us here today. It's been a pleasure having all the wonderful questions come in. We're very happy about how the markets have played out over the last 6 months, and we're looking forward to meeting with you all. If you have any additional questions, please reach out to us. We're more than happy to help you along. All right. Thanks so much for joining.
Thanks,
Bye,
everybody.
guys.
Bye.